Hello and welcome again. My name is Tristan Thomas with List Academy, and in this video we're going to go over what we call universal life explanation. Now this is a simplified sales method that will help assist in the conversation of how a UL policy works. Now to do this video, what I want to do is I want to give you an example of a case that I was working on about two weeks ago with a client that came in to talk to me about their old universal life policy. Now this simplified sales method that we're going to go over worked so well that I thought about making a video about exactly how I presented how a UL policy works to that particular client. Now, that particular client had a policy purchased from a different carrier, and they purchased it about 10-12 years ago. Before they came in, I asked them to bring in an in-force illustration, and when I looked through the in-force illustration, unfortunately that policy was going to lapse in about 2 to 3 years. The client also brought to me another illustration that the carrier brought to them where they had to double their premium, and that policy was only going to last for another 10 years. So the problem that the client was having was, one, they were very confused on exactly should they pay what they currently pay, which is what the old agent told them, or should they fund it more and stay with the particular policy. The problem was either route that they went, it was just a glorified term policy. So before I even went into any illustration on exactly why they should come over to us as a carrier, what I wanted to do is I wanted to explain to her exactly the benefits of a UL policy and just start from the ground and work my way up. So we use the same exact method. Now, in this method, what we're going to go over now, the benefits to the client is it's an understanding of the need of funding a policy properly. We always talk about this flexibility that a UL policy has, but your client has no true understanding as to exactly how the flexibility can actually impact their policy. A lot of clients, what they do is they think that, well, all I need to do is pay X amount of premium for so many years, and then I can reduce the premium. But the problem is, after a year or two, that client just automatically wants to reduce the amount of premium that they're paying into the policy. And we both understand that that's not how you fund a UL policy properly. So this is going to help them understand a little bit more as to exactly why they should fund it for a longer period of time until there's enough cash value in the policy. It's an explanation of a UL policy that's simplified, that they can actually understand, that makes sense to them and empowers them to make a better decision on protecting their family, but also being able to have this policy in force that they can use the cash value for whatever they want to use it for. It gives them the confidence in purchasing a policy that'll stay in force for the rest of their life, right? I always say, what's the best policy that's available when it comes to life insurance? Well, the best policy is the one that's in force when you pass away. So the last thing that we want to do is give them another glorified term policy, as I talked about previously. For the agent or the advisor, so for you, it's a strategy to transfer underfunded UL policies. Like the example that I gave earlier about that client that brought over that information about her existing policy, what it was an opportunity for me to say, you know what, obviously this isn't working out with what you have currently. Why don't we give you a better policy over here where you're paying enough premium so this policy stays in force for the rest of your life? It gave me that opportunity because I went over this simple sales method. It's a proper explanation on how a UL policy works, as you know, and increased premium per UL policy as well too. So maybe you as an agent or an advisor have sat down with clients before and you sold them a UL policy. Now, because of the interest rate market that we're in today, maybe a lot of those policies are being underfunded. So this is an opportunity for you to talk to those clients about the need to increase the amount of premium that they have. So when the question then becomes, well, when should I use this idea? Well, when should I use this? Well, when discussing how a UL policy works. Never assume that your client already has an understanding of exactly the ins and outs of a UL policy. Start from the ground and work your way up like I did with the other client. When competing against the UL policy that is being underfunded is also another time you should use this. Let's just say that you're up against another carrier and you're saying, Mr. Client, the cost will be $300 per month. But then the other carrier that you're competing against is saying it's only $100 a month. Well, you and I both know that the policy that the other carrier is showing them is not going to last for the rest of their life. So again, you want to show your client exactly why they should fund a universal life policy properly. And this method does just that. So let's jump into it. Let's show them exactly what we would do when it comes to how a UL policy works. Now, what I'm showing you right now, again, is exactly what I showed that other client of mine that I talked to about a UL policy with her underfunded one. So what I did is I had a blank sheet of paper and I said, Miss Client, but before we go into exactly which policy would be best for you, let's talk about exactly how a UL policy works. Would that be fine with you? And she said, absolutely, that's fine. So what I did is I started drawing steps, as you see right here. Little steps here and there. And what I said is, these steps, Miss Client, is the cost of insurance. With a UL policy, the cost of insurance will increase each and every year. These are 1-year renewable terms in any UL policy, regardless of the carrier. Now, our whole goal here is to pay a premium that's high enough at a level where when the cost of insurance is at a low number, a low dollar amount, our premium is at a higher dollar amount, and there's a difference between the two. The reason why we want that difference is because that helps to build cash value. Now, that cash value is going to be a fluctuating rate. It's dependent upon interest rates within the market, but it can never be less than 2% regardless of the company that you're with. Now, VULs, which are variable universal life policies, are a little bit different, but in this interest, in the gist of any UL policy, it can never be less than 2%. So what happens is, each and every year you're paying the same amount of premium and the cost of insurance will keep increasing, which also increases the cash value that you're accumulating. Now, what's going to happen eventually is the cost of insurance will exceed whatever premium payment that you have. So what happens is when we reach, say, this level, there's two different options we have. The first option is we can use the cash value that we've accumulated, which is a benefit to you, to pay for that additional premium. We have that ability, right? So the cash value pays for the additional premium. Or what we can do, and not many clients want to do this whatsoever, is we can actually have a higher premium payment. So we can pay additional premium if we would like to do so. Cash value will keep building as is, but we're paying additional premium. The problem is, though, the additional premium will keep increasing each and every year. So you have those two options. Hopefully, what we want to do is we want to use the former option, which is using the cash value to pay for the additional premium. As you can see right there. The problem is a lot of carriers, or in my particular case, the illustration that was shown to my particular client, is that their premium was so low that when the cost of insurance was low as well too, that there wasn't enough cash value being built up into the policy, which now this was 10 or about 12 years out. Now, what was happening was the cash value was paying for the additional premium, but when it reaches this year, or this year, or this year, what happens if there's no cash value? If there's no cash value, there's not enough cash value to sustain the policy, so what will happen is the policy will lapse. That's the problem, because we don't have any more cash value. The only other option we have, and what that illustration was showing my client, was that they were actually going to pay double the premium so the policy stayed for a longer period of time. But again, in that illustration, it was only for an additional 10 years. So in year 8 or year 9, she was going to go through the same problem that she was going through as of right now. What we want to do, so I show them this, is I say, our goal here is to pay a high enough premium so when the cost of insurance is low, that cash value is being built up. And each year going forward, the cash value has enough time to build. So when we get to this year, or we get to this year, the cash value pays for the additional premium. Or in that year, cash value pays for the additional premium. So that's exactly what I wanted to do and to explain exactly how a universal life policy works. Now, when I sat down with my client to talk about this, they were a little upset with the policy that they purchased 10 or 12 years ago. And the reason why is because they now understood that this policy was not going to last for the rest of their life. So what I wanted to do is empower her to make a better decision on her particular situation, which in this case was purchasing a different policy, completely separate of a universal life policy. So we ended up closing a whole life policy because what she liked is she liked the guarantees associated with that. So what I first wanted to do was explain to her exactly how a UL policy worked. So now the benefits of going over this explanation for the client again is an understanding of the need of funding a policy properly. Now, because this was an old case, what I wanted to do was not try to sell her another UL because she thought she could have that same problem again. Strategically, what I thought about doing was focusing on a UL because of the guarantees associated with a whole life policy because of the guarantees that were associated with a whole life policy. What this did was it gave her a better explanation of how a UL policy worked as well, and it gave her the confidence in purchasing a policy that'll stay in force for the rest of her life, which in this case was a whole life policy. Now for the agent or the advisor, so for you, it's a strategy to transfer underfunded UL policies. I can't tell you how often I have conversations with clients that have old, previously purchased UL policies that are coming due, that will lapse in 3, 4, maybe 5 years. So what I want to do is I want to take as much time as I can to explain how a UL policy works to clients that are out there that purchase these policies. So it gives me the opportunity to show them something better or help them fund a better policy. Now, again, this helps to properly explain how a UL policy works, and it gives you the opportunity to increase the premium on UL policies that you may have sold before. There's 2 cases you have if you sold underfunded UL policies in the past. 1, you can just forget it and not tell your clients about it, but there will be someone else that'll come in there and take that business from you. So take that opportunity to meet with your clients first before someone else does. Or you can proactively talk to your clients about why they should fund a UL policy properly by increasing the amount of premium. You have that choice. Now, again, this is called Universal Life Explanation. Hopefully this sales method will help you with your conversations with your clients. My name again is Tristan Thomas with the List Academy, your life insurance sales experts.